If you're behind on your mortgage payments or simply having difficulty staying current with your payments, you may have either considered refinancing your payment plan in lieu of short selling or letting your house go to foreclosure. What many homeowners don't realize is how difficult it is in this economy to actually refinance a mortgage unless you have close to perfect credit. Mortgage companies are now starting to stop foreclosure sales as a result of the government taking over Freddie and Fannie. The banks are sending short sales back to the homeowners to attempt to modify their loans first so as to allow them to keep their home irrespective of their failure to pay their mortgage payments. Therefore, debtors will begin to see an order of process for homeowners to fight to keep their homes in these unprecedented times of financial suffering. A loan modification will likely be the first step for homeowners to consider. A loan modification is simply homeowners asking the mortgage company to modify the current terms of their mortgage. Homeowners will ask a mortgage company to modify their mortgage because of being late on payments, variable interest rates too high, or monthly payments being too high, and other such hardships. Homeowners can seek this relief on their own, directly with the mortgage company, or through the assistance of an attorney. There are many aspects to modifying your payment terms that differentiate refinancing a mortgage to modifying a mortgage. When refinancing, you may or may not move into a fixed interest rate. You may or may not decrease your payments. The biggest benefit to refinancing is often the ability to pull out equity in order to pay other bills. As stated earlier, you'll need to have very high credit in this market to refinance. A loan modification is generally considered a short-term refinance in order to help you get back on your feet or to wait out this uncertain real estate market. You'll be moved into a lower fixed interest rate for 5 or 10 years. The most significant benefits of a loan modification is that your credit score does not come into play. An attorney will negotiate with a bank on your behalf based upon your hardship. As such, your credit is not affected with this change. There are no closings needed in loan modifications as there are in refinancing. As such, there are no closing costs, no points being paid, no new title insurance fees, no application fees, or any other fees typically incurred in a traditional mortgage transaction.